options that'll pay interest credits. What hurts policy cash value? Well, policy expenses. We'll talk about a few of those. Cost of insurance, policy fees, and your allocation options. You could have some fees for the chosen allocation options that you go into. And then, of course, anytime you take a loan or withdrawal, it could hurt your policy cash value as well. So, high level, this is how index universal life works. Your client pays their premium, that goes into the policy. They'll have interest credits that are credited to the policy over time. Hopefully they're positive, right? We can't guarantee that, but generally the market's proven that it will go up over time. And then, what's hurting your policy cash value, the expenses in the contract, which go over those in a little more detail here. And then, of course, anytime you take a loan or withdrawal, it could hurt your cash value as well. High level, folks, that's how it works. That's it. As I said at the beginning, it's all about downside protection. Your IULs have different allocation options, but understand this, your allocation options are not invested directly into the market. Okay, that's how variable universal life works in what are called sub-accounts. These are allocation options where you are not directly invested in the market, rather, excuse me, the voice is a little raspy today, so I've had to take some drinks of water there. Pardon me. Index universal life, similar to traditional universal life in the fact that how the policy works, the difference is how the interest is credited, and you have downside guarantees. Excuse me, I hit that too fast. You have guarantees with the allocation options because you're not directly invested in the market. What are some of those fees? Well, you have cost of insurance, cost per thousand, policy fee, premium expense. Let's talk about what those are briefly. Cost of insurance, basically that is a cost based on the client's age, gender, underwriting class, all kinds of things that go into that, and also based on what's called the net amount of risk. Okay, all the net amount of risk means is a fancy term for what's the difference between the client's death benefit or the policy's death benefit and the cash value. That's the net amount of risk. Cost of insurance will be a factor that's charged against the net amount of risk. If you want to get more details on expenses on a policy, you can always add them to the illustration. You also have your cost per thousand. That's basically to make up for the client or for the company paying you commission. Some of those costs per thousands, it varies by carrier. Sometimes they only charge for 10 years, sometimes they charge for 20, sometimes for the life of the policy. And then you have a policy fee, which normally is a pretty nominal amount, and then a premium load or premium expense. What that means is there are some carriers, they will, when you pay your premium, let's say you pay $10 into the policy, which of course you should probably pay more than that, but hypothetically, you pay $10 in, they might take a small part of that off the top, right? Maybe an example, if you paid $10, they might take 50 cents off the top. Again, some carriers, meaning that only $9.50 was applied to the policy, right? It never even got to the policy. Some carriers, they charge a premium expense for the first 10 years. Some people charge premium expense for 20 years. Some people only pay premium expense up to target. Some people will pay premium expense. Some carriers will charge a premium expense for the entire length of the contract. Again, you can always add the cost and expenses on the illustration. It's an optional report that you can add. All of our carriers make that an option. But just beware, there's a lot of information there, and it could confuse a client, so it might be best for you just to look at it before going to the meeting, and maybe not showing that to a client right away unless they ask for it. When it comes to allocation options, this is the driver of cash value growth inside your index universal life policies. There's a number of considerations. Is the index, where is it based? Is it domestic index like the S&P 500? Or is it something that's international or global, whatever the case may be? You have a lot of index options that you'll find once you start diving under the hood on how this works. What about the length? How many years? Generally speaking, with index universal life policies, we're talking about a year. On some fixed indexed annuities, which we're not going to go into today, we're not going to delve into that, but on some fixed indexed annuities, you'll see 2-year allocation options. And of course now, then what's the strategy? Is it capped? Is it uncapped? Is there a spread? What's the participation rate? We'll talk a little bit more about that. Let's first talk about, though, the concept of annual point-to-point. This is very, very important for index universal life. One must understand what is meant when you say annual point-to-point. What annual point-to-point means is we're going to look at what the index value was on a given date. Let's just use January 2nd, 2023. And then we're going to look at what the index value was on January 2 of 2024. That's the annual. And point-to-point means we worry about what the values are on those 2 days, and only those 2 days. So what you're seeing here on your screen is a hypothetical index showing the annual return. You can see in January, you were about at 1,200. And by the time you got to the end of the year, it really should say January of the following year, because that's what it's going to measure. You're up to approximately 1,350. What annual point-to-point is going to measure is what is the percent increase between those two numbers, between 1,350 and 1,200, right? I'm going to go through a mathematical example here in just a moment to show you how it all works. But it's measuring the difference, percentage increase, decrease, whatever it happens to be, between those 2 points. The fact that the market was down in April that year doesn't matter, because it's only been 4 months. It's all about how it was going to be at the end of the year. Now let's talk about adding capped. And the reason I chose to go over what a capped annual point-to-point is because a capped annual point-to-point is one of the most popular, if not the most popular, options for sorry about that, folks. I had a phone call coming in there. It is one of the most popular options out there in Index Universal Life. It is heavily utilized. So what does this capped annual point-to-point do? Again, it's annual point-to-point, so we're looking at one date and time versus a year later, that same date and time, exactly 1 year later, and we're going to measure the percent gain. Now, but when we add the cap, you see the dashed orange line there across the graph there? That represents the cap at 11%. It's hypothetical. It's not matching anything or mirroring anything. It's a hypothetical cap at 11%. And the other axis, you can see the percent gain. The blue line there represents the percent gain at a given point in that index. So as you can see, January, February, kind of flat, and then you have a big spike in May and June, and it comes back down to earth, whatever the case may be. You're capped at 11. So you can see, approximately maybe ending the year at 7 or 8%, right? When you look at the far right side. But the fact in May and June that the market was up over 20% doesn't matter. It doesn't matter because I've got to wait till the end of the year to determine what the cap gain is going to be. When you look at this, what's important to remember is that you have your cap. That will not change in that given year. And we're looking at the percent gain, or we're looking at the difference in values from when the index allocation option started, when it's going to end a year later. Let's do a mathematical example and see if that's helpful. So let's assume we're looking at a capped annual point-to-point with a 10% cap. When I say a 10% cap, it means this allocation option will not credit any more than 10%. Regardless of the market performance, how high it goes, the highest the client can get is a 10% interest rate credit that year. So you have your beginning index value when the index started at 1,200. The ending index value, and this again, it's all hypothetical, it's 1,377. So we got to do some math to figure out how this would work. In this example, the way this operates is we're going to take the ending index value, the 1,377, and we're going to subtract it from the beginning index value. And then we're going to divide that by 1,200. The reason we're doing that is we're just calculating the percentage gain, right? That's just how it works. That's how you do it. You subtract the ending value minus the beginning value and divide by the beginning value to get a measure of the percent increase in gain. And that will give you 0.1475. We're going to turn that into a percentage, and that equals 14.75. So the index, forget about the cap for a second, but the index increased 14.75%. Now, in this example, 14.75 is obviously, it's certainly greater than 10%. So the interest that would be credited to the client that year would be 10%. Even though the index went up 14.75, the cap is 10, you're capped at 10. Now, what would have happened? Sorry, I didn't mean to hit the button there. What would have happened if the index was only up 4%? Well, in that case, because the cap is at 10%, the client's going to get all 4% of the index gain that year. The reason I give that example is because I don't want people thinking you only get 10% of whatever the market does. That's not how it works. That's what a participation rate is. We're going to talk about a participation rate here in just a minute. But the cap means you're going to get up to the cap. Anything above that, you don't get. Real quick, just to make a point, let's assume in this given year the index was down. What does the client get that year? The client gets a 0. If the market was down, if the index was down 16%, the client gets a 0, not a negative 16. I'm pausing here real quick. It looks like we have a question. I'm trying to pull it up here. Okay. Someone asked, so annual accumulations based on policy cap and market rate. The annual accumulation is based on a number of things. Thanks for asking the question, Faye. It's based on a couple of things. One, if the client pays premium, that will obviously increase their accumulation value, right? If you're adding money to the policy. But as far as how that premium then grows and accumulates over time, it will depend on the allocation option that's chosen, right? So in this example, or the example that we just covered, it was based on the cap. And then that cap will be applied to whatever the chosen index, however it performs. So hopefully the example we just went over, Faye, is helpful in showing you how it worked. But yes, the index accumulation or the accumulation credits will be determined by the index and the allocation options chosen. And then that is just applied to the policy as a percent credit. Oh, you're welcome. Okay, so we just talked about one way, one allocation option, how that works. Look, it can be assessed. Why do we care about cash value, right? Like, I just want to take a step back here and say, well, what's this cash value all about? Well, look, you can access your cash value. Your client has the right. They don't have to, but they have the right to access their cash value. There are some things that apply, some things you need to be aware of. But you can either take what's called a loan, where you're technically borrowing money from the policy, or you can just do a withdrawal. What you should know about either of those is that loans and withdrawals will reduce the cash surrender value and death benefit in the policy. Generally speaking, loans are going to be probably more advised than withdrawals. Why? Once you take a withdrawal, it's permanent. You can't get it back into the policy, right? At least not without creating a mech or doing maybe some other adverse consequences. When you do a loan, you can simply just pay the loan back. Now, there are some risks to taking loans. We're going to talk about how loans work here. Regardless, whether you do a loan or withdrawal, assuming the policy is not a modified endowment contract, a non-MEC, meaning you haven't failed the 7-pay rule. Hopefully you guys remember all that from your life insurance tests that you had to take in your respective states. But generally, they're income tax free. So that's a really big benefit because clients don't have a ton of ways to access money in an income tax-free way. A note on withdrawals: if the client does take a withdrawal is tax-free up until you reach the cost basis. What's cost basis? Cost basis is a big fancy term for how much money I put into the policy, right? If I paid, let's say over 20 years, I put $20,000 into the policy, and my cash value is now $30,000. My cost basis is $20,000, meaning I have $10,000 in gain. When I take a withdrawal, I can withdraw $20,000 first and not pay any income tax. If I continue taking withdrawals and I start withdrawing the $10,000 gain, that will become taxable. If I do a loan, all of it's income tax free because I'm technically borrowing the money. I haven't looked through it. I hope that makes sense. A little hard to illustrate over a PowerPoint, but I just wanted to make that note since we're talking about the tax benefits there. There are different loan types. Not all loans are created equal when it comes to index universal life or just cash value life insurance in general. Loaned money technically is still part of the contract. Now, if you take a loan out of the policy, the client dies, that loan will be paid back to the carrier before the death benefit is paid out to the beneficiary. So, quick example: let's say I have a $100,000 policy and I've taken a $10,000 loan. The insured passes away. The face amount was $100,000 with a loan of $10,000, so $90,000 will be paid to the client's beneficiary, so the insured's beneficiaries. The other thing to be aware of with loans in particular is that oftentimes loans have two interest rates. And this is kind of strange to think about because when you think about a loan, you're probably thinking about a bank, right? Where you go get a mortgage, or you go get a car note, or you go get a personal loan, or whatever kind of money you're taking, right? Okay, or whatever kind of money you're borrowing, I should say, rather. And it's well spelled out. This is what your annual percentage rate is. This is what the annual percentage yield will be. This is what the amortization schedule is. This is when the loan should be paid off under this schedule, all this kind of stuff. With index universal life, your loan is going to be simultaneously. There's going to be a percentage charged against the loan, like you have with a bank loan. Yet at the same time, the insurance carrier is also going to credit money to the loan at the same time. It will happen simultaneously. And I know that seems kind of odd. It seems strange. But the reason carriers do that is they actually, not all of them, but many of them will do it today, with the opportunity to offer clients a true net zero cost loan. That is done normally with three different loan types just showed up here. That's normally done or can normally offer what are called standard or fixed loans, depending on the carrier. Standard or fixed loans, you have participating loans, you have variable loans. Variable loans are the least common. Standard participating, far and away, are the most common. Participating loans probably being the most utilized. And the reason I say that is because your default illustration, if you're showing loans coming out of an illustration, it is almost always defaulting to a participating loan. Let's talk about how these work. So let's start with standard loan. It's the easiest to understand. I think it's a good place to start. It's also the most predictable loan. Pardon me. The visual you're seeing on your right here, the green line represents the amount of money the client, or the rate rather, that the interest is being credited to the client. The red one's when they're being charged. And again, this is happening simultaneously. In this example, let's just say they're crediting 1.5% and they're charging 2%. So the loan would have a net cost to the client of 0.5% or 50 basis points. Now, oftentimes, if the client waits long enough with standard loans, they can actually have the amount charged and the amount credited can be the same. That's how you get your net cost zero loan. So the client can borrow money from the policy for absolutely no cost. And you look at where interest rates have gone today. You go to the bank today and you want to take a personal loan. Those rates could be anywhere from 10% if you want to just what's used to be called signature loans. You look at car loans. Mortgage rates are above 7% now. Rates have gone up considerably over the last 12 months. But yet if you have an IUL with that has the option for fixed interest, or with a standard loan, if the policy's old enough, normally standard loans can be available at zero cost, a net zero loan, and that's really powerful. Let's talk about participating loans. These are the most common. Again, you're going to have an interest rate that's charged, and that's going to be fixed. You see that in the red line, it's just going straight across. But the amount that's credited isn't just a declared amount by the company. The way it works is whatever your chosen allocation option was, that money is still in the allocation option. I know the client's borrowed it, but it's still allocated to that allocation option. And the interest credit that's going to be determined will be the interest credit that's credited from the allocation option. So quick example, I think it's the easiest way to understand it, is just a quick example. Your client's going to take a loan, they're going to borrow $10,000 from their IUL policy. And let's say the Index Universal Life Company, the carrier, is charging 6%. Again, all hypothetical, 6%. The interest rate that's credited will be based on whatever your chosen allocation option is and the returns of that index. So you're being charged 6, you're in a cap gain on point-to-point account, let's say it earns 8% that year. You'll be credited 8%, you'll be charged 6%. Your client actually made 2% on their loan. Positive arbitrage. That's how arbitrage works. I know it's a big fancy word. All it means is that you have the opportunity to actually make money on your loan. You were credited 8, you're charged 6, that's positive 2. Now the downside is this does carry some more risk. You're getting charged 6, what if the allocation was down that year? Right? And your client gets credited at 0. In that case, they're going to get charged 6% on their loan. Right? So that's how it works. Generally, probably the most common type of loan taken, only because that is what is illustrated. And because you have the opportunity for positive arbitrage. Then you have variable loans that work very similar, but the loan interest rate changes more. It's just variable over time. There aren't a lot of carriers that even offer them anymore. But they are still out there, so I wanted to bring it up just because we're having the discussion. Works very much the same way. Your client's going to be charged something. There's also going to be credited. The credit's done based on however the allocation works, but that interest rate that's being charged will fluctuate a lot more over time. All right, we're heading here towards the end. What are some of the benefits of Index Universal Life? I want to take a step back, look at this from a whole. Your tax benefits, tax deferred accumulation. We talked a lot today about how cash accumulation occurs inside the policy, right? You pay premium, you have interest credits. There's also other things too, like persistency bonus and interest credits that are given once a policy is enforced long enough. We didn't really talk about those because they really vary by carrier. Generally, income tax-free death benefit. The only time it wouldn't be tax-free is if, sometimes with business-owned policies, you can run into an example where it could be not tax-free, but if you're just talking about something where, you're sitting down with mom and dad from across the kitchen table, dad buys a policy, he's the owner, he's the insured, and his spouse is the beneficiary, that's going to be tax-free. And of course, the potential for tax-free distributions. We talked a lot about risk management today as well. Reduced volatility compared to alternative policies, particular variable universal life policies. More upside potential compared to fixed traditional universal life policy. Limited downside risk from market performance. The guaranteed floors. And that bottom bullet point is all possible because we are not actually invested in the underlying index. Very important. Not invested in the underlying index. Rather, we use the index as a barometer to determine what the interest credit will be. One thing we didn't talk a lot about today, but it's something you definitely should be aware of, is all the flexibility that's inherent in Index Universal Life. And this is current assumption universal life. There's a whole different range of Index Universal Life policies called protection focused or guaranteed Index Universal Life. Doesn't really apply to this. I'm talking about traditional current assumption Index Universal Life. That we sell a lot of here at First Financial Security. A lot of flexibility, and you can help a lot of different people with it. First of all, so many different designs, short pays to 120. You can pay more premium years 1 through 10 and less than 10 through 20. All kinds of different things you can do. You can design them for max cash accumulation, or you can design them to get as much death benefit out of the policy as possible. Obviously, it can help with individuals. It can also help with business owners. It can help with high net worth families, high net worth individuals, doctors, attorneys, all that kind of stuff. Business owners, as I said. And then something we don't talk a whole lot about is you have the opportunity to make adjustments to policies once they're already enforced. And this is something that guaranteed policies you really just can't do, or you certainly can't do as readily or as easily. You could change your premium in the future. You could put more money into the policy, put less money. You could reduce the death benefit. You could apply to have the death benefit increase, which may require underwriting. There's so many different things you could do to the policy once it's already in force. At this time, I know we've had some people ask questions along the way. I appreciate that. I'm going to pause.